Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Amira Syafiah binti Syamsul Kamal, and together with my friends Amira Najiha binti Azman, Intan Syahirah binti Abdul Salam, and lastly Nurul Atira binti Zulkifli. Today we will present a case study regarding financial report on the Huawei company that we have chosen.
Assalamualaikum and hi. Our study company is Huawei Investment and Holding Corporation. Huawei is a leading global provider of information and communications technology (ICT), infrastructure and smart devices founded in 1987, which committed to bringing digital to every person, home and organization for a fully connected towards becoming intelligent world. Throughout this study, the financial ratios of the company have been identified. There are four types of ratios that are involved, such as liquidity ratios, activity ratios, leverage ratio, and profitability ratios. Liquidity ratios is an ability of the company to meet short-term obligations and pay their creditors when the payment is due. Meanwhile, activity ratios is an efficiency of the company in using their assets to generate sales. Next is leverage ratios, which determine the company's borrowed capitals or loans. On the other hand, the profitability ratios will indicate the profit and sales rating of this company. Financial ratios helps in analyzing company's economy. This information will be used by the manager, then investor put a decision making to either to invest on the company's common stock. Thus, the financial ratios act as an indicator of the company's health. Based on the calculation, the table shows the liquidity ratio for both year in 2019 and 2020 of Huawei corporations. There are current ratio, quick ratio, and net working capital. From the data provided, as we can see, the current ratio in 2019 is 1.57 and 2020 is 1.76, higher than 2019, which remarks as good result. In quick ratios, 2019 shows 1.2 and 2020 is 1.33, higher than 2019, which indicate as a good result. Net working capital for year 2019 is 257,638 ringgit. Meanwhile, in year 2020, give 299,062 ringgit, higher than 2019. A positive result of net working capitals in company shows that the company have more current assets than the current liabilities. Based on the results, we can conclude that the liquidity ratios of the company in 2020 shows a better performance compared to year 2019. Results shows slightly higher ratios compared to the previous year on 2019. Results, the company able to meet short-term obligations and have enough resources to pay their creditors on due.
Moving on to activity ratio. The first one would be inventory turnover, which is into. So into shows how many times that the companies turn over its inventories in year. Basically, higher ratio is more favorable. So the formula would be cost of goods sold divided by inventories. So as we can see in 2020, the company has 3.365 times ratio compared to 2019, which is 3.32, and thus the company shows a good performance. The second one is days to sell inventories. It is actually shows how many days that the company needs to clear its inventories. Shorter days is more favorable. The formula would be inventories divided by cost of goods sold. In the year 2020, the days taken is 107 days, while in 2019, takes 112 days. It shows that the company managed to shorten the days in about 5 days compared to before. This, the company shows a good performance. The third one would be average collection period, which is ACP. ACP is actually shows how many days that the company takes to collect its account receivable. So shorter days is more favorable. The formula would be account receivables divided by credit sales times with 360 days. In 2020, the company takes about 30 days to collect its account receivable compared to 2019. The company takes overall 36 days. So we can see that there is a 6 days difference in 2020, which shows that the company has a good performance. The next one is average payment period, which is APP. It shows how many days that the company takes to pay its debt to creditors. So shorter days is more favorable. The formula would be account payable divided by cost of goods sale times with 360 days. In 2020, the company managed to pay its debt in 50 days only. While in 2019, we can see that the company takes about 95 days to pay its debt. So we can see that there's a 45 days difference in 2019 compared to 2020. Thus, the company shows a good performance. Another one is fixed asset turnover, which is FATO. It is actually shows the effectiveness of the company in using fixed asset to generate sales. Higher ratio is more favorable. So the formula would be sales divided by fixed asset. And in year 2020, we can see that the company has ratio of 4.806 times compared to 2019, which is 5.549. So the company shows poor performance. The last one is total asset turnover, which is TATO. Basically, it is the same with the FATO, but the calculation is using the total asset. Higher ratio is more favorable. The formula is sales divided by total assets. So in year 2020, we can see that the ratio is 0.9125, and in year 2019, we can see that the ratio is 1.0002. So it has 0.09 lower in 2020 compared to 2019, and thus the company shows a poor performance. In overall, based on the activity ratio, the company has a good performance in year 2020 compared to year 2019. And basically, the amount of sales generated every dollar from asset management increased in year 2020. And that's it.
Next is leverage ratio. Leverage or gearing refers to the use of borrowed capitals or loans. So, this ratio measures the level of debt in a firm. Thus, whether the company uses more debt or equity in its financing, measures the ability of the firm to service its debt obligations, and it also shows the extent of financial risk. High risk if debt is too large. Leverage is used to increase the potential return from an investment. However, it could also increase the financial risk. Should the investment fail, the firm still has to pay the debt, which is principal plus interest. First, debt ratio is equal to total liabilities divided by total assets. Debt ratio shows the percentage of total debt given out by creditors. Low ratio is more favorable. Based on the Huawei company in 2020, the company shows a good performance compared in 2019 because the company has low ratio, which means the company not borrow too much, which is low risk. Second, debt to equity. Ratio is equal to total liabilities divided by total equity. Debt to equity ratio shows the portion of debt being used to support for company's operation relative to equity. Low ratio is more favorable. In 2020, the company shows a good performance compared in 2019 because the company debt is not too much and less volatile. It is also lower the financial risk. Third, long-term debt to equity is equal to long-term liabilities divided by total equity. Long-term debt to equity shows the portion of long-term debt being used to support for the firm's operation relative to equity. Low ratio is more favorable in 2020. The company shows a poor performance compared in 2019 because the company long-term debt being used for the firm's operation relative to equity is more. Lastly, time interest earned is equal to EBIT divided by interest expenses. Time interest earned show the ability of the company to service debt payments. Higher ratio is more favorable. In 2020, the company shows a poor performance compared in 2019. Thus, the company are not able to service its debt obligation. Based on the leverage ratio, the company are balanced between good and poor performance in 2020 and 2019. However, for overall leverage ratio, it's still considered as good performance.
The last ratio is profitability ratios. Profitability ratios indicate the rate of profit on the sales, which show the profit earned for every RM1 ringgit of the investment and measure the overall of the management effectiveness. Looking at the ratio, in the year of 2020 compared to in the year of 2019, the gross profit margin or GPM is 0.87% lower. Next, the operating profit margin or OPM is 0.93% lower. Next, the net profit margin or NPM is 0.05% lower. And then the ROE or return on equity is 1.63% lower. The, the GPM, OPM, NPM, and ROE are all lower in the year of 2020 in the comparison to the year 2019, except for the ROI or the return on investment, which have a slight increase of 0.07% in the year of 2020. Based on the profitability ratios, the company have poor management effectiveness. The company have poor performance. They have a lower rate of profit on sales in the recent year of 2020 compared to in the year of 2019.
Based on the company performance in 2020 and 2019, the financial ratio in 2020 is better compared in 2019. Liquidity ratio, efficiency ratio, and leverage ratio in 2020 are in a good highly ratio than 2019. Meanwhile, profitability ratio of the company in 2020 are in a slightly poor ratio compared to 2019. Therefore, it shows that the company are quite financially strong.